Kitco Mining special coverage of the Mining Investment Event of the North is brought to you by EMX Royalty Corp.
Gold prices are looking for direction following the Fed's rate pause last week. So let's see if we can get some pointers for gold investors from Frank Holmes. Frank, of course, is the CEO and Chief Investment Officer of U.S. Global Investors, and he's also a frequent guest and contributor to Kitco. Frank, welcome back to Kitco.
It's great to be here and in Quebec City, and what a huge, successful conference.
Yeah, it's looking very good. So I have a few places to go with you today. I want to know which miners you're looking at. I also want to talk a little bit about the U.S. economy, especially since last week. But let's start with gold. So in your latest investment alert on Friday, you pointed out that we saw a stronger euro coming out of the ECB's comments, and this weakens the U.S. dollar index. This provides a boost to gold. But on the other hand, our U.S. data is potentially holding gold back. We have what appears to be improving economic indicators, employment, inflation, the CPI data, which people were positive on. We'll get into that. So we have the central banks kind of pulling and pushing gold in different directions, and we have gold looking for direction. How do we play gold in this type of an environment?
Well, first of all, gold is a special decentralized asset in all these different countries and how they're trying to figure it out. But bad news is good news, because that bad news is triggering MMT, modern monetary theory, which has been practiced since 2001 by the G20 countries. And interesting enough, since the beginning of this century, gold has been positive 80% of the time. It's hard for people to understand that, and it's outperformed the S&P 2-1. So having some exposure to gold is just relevant and wise, and that's what the largest hedge fund in the world, Ray Dalio, does, and he does a pair of trading, and it's always some gold from 10% up to 25%. So from that end, the bad news is we're worried about the economy. The bank's balance sheets, $700 billion offside. We have to get the rates down. And that sort of concern now with, if we go back pre-COVID, 8% of the population worked from home. It's now 30%. Now we have all those skyscrapers in downtown New York, in San Francisco. We have other social issues in San Francisco. People don't want to live downtown. Citadel Capital moves from Chicago down to Florida. So you have all those mortgages rolling over, people aren't going back to work, and then all of a sudden you're going to say, I'm going to get rid of that space. To who? And then you're now the owner of the real estate, and you got to roll over your debt. We got a big crisis brewing, and so they've got to stifle the interest rate rising, and that is really positive to get the economy all of a sudden on track. But in the U.S. it's interesting because the best leading indicator for manufacturing is PMI, and it's below 50 now. That's not good. But the airline industry, which I have the JETS ETF, it's a wonderful leading indicator. It bottomed when COVID was the worst, and then it doubled from that price level as the vaccine rolled out. It's like a 6-month leading indicator, and it just hit $20 this past week. Where was it at the beginning of the year? Like 15, 16. So it's sort of telling you that there's something positive on the economy for people traveling. And so for that, I remain bullish. Last thing is, going back almost 80 years in the presidential election, when the president is a Democrat and the Congress is a Republican, in the third year of an election, there's a 95% probability the market's up. Now, a rising market, stock market, is very bullish and needed for stocks and gold stocks in particular. So I think we're in a position where we can see gold to start to modestly climb and the gold stocks really make it a terror, a big breakout. We go back to 2013 when we had this sort of scenario. The big gold producers, I follow 100 of them, there was only like 12 or 13% had free cash flow yield. Today, 60% too. So the balance sheets of these companies is very strong. There's better governance, and for them to grow, because there's a supply of gold mining is basically halted of new supply, they're going to have to buy these juniors that are here, and they have to find those deposits. So it's setting up to, as they say in the crypto land, buy the dip and hold on for dear life. But the idea of being contrarian is important. The negative news is good news.
All right. Now, this is interesting because we've been hearing a lot over recent months about when are the valuations of the gold companies, not just the juniors, but just the gold companies. They're historically undervalued relative to the price of gold. So when are they going to catch up? What's it going to be? So you seem to be saying that the way to play gold right now is to be looking at the producers. And if the economy improves, if this is good for equities, then the smart money will be in investing in the gold companies themselves.
Correct. Because they start to show up in the quant models. Their revenue last quarter is above 4 quarters. Their cash flow last quarter is above 4 quarters. That scenario on a per share basis, all of a sudden they start populating Investor Business Daily. Gold stocks on a relative basis have stronger fundamentals. What they did previously is they made a series of bad acquisitions that destroyed the value on a per share basis. So two companies, yes, our revenue grew and our cash flow grew, but you issue so many shares that do that, on a per share basis, they fell 30%. And that sort of scared people away from that space. I think that's behind us, and I remain very, very bullish that governments around the world are very concerned of a slowing economy, because Germany, its PMI is like 42. Well, during COVID, it was 32. And they had all these crazy policies of climate change that were way too early, and they are basically listening to NGOs funded by Putin, and they shut down their whole system, and now they're relying on him. So that economy is the biggest and most important in Europe. It's got to turn around and start spending money, turn that around, or they're going to be out of business. I don't mean business, I mean the politicians will be out of business. Right. So we get these election cycles that are very important for the economy being strong. So I think that Europe is going to see higher highs.
So you think Germany is going to be able to pivot to, they're going to be able to pivot their industrial model away from Russian gas and away from, it was the foundation of almost everything they were doing. Their entire plastics industry was based on cheap Russian gas and totally dependent on Russian gas. So you see that happening in the
I do, and the growth in solar, which is good for silver. It's also a big need for copper, and the second biggest gold mine, Barrick, is now looking for copper because they see the demand is great, but the supply is contracting. And the Chinese get control of these countries in Asia, now Latin America. All of a sudden, they're controlling the supply. That supply is going to go back to China, not to America. I think we're going to see a real pivot change, that the value of an ounce of gold in North America is going to actually go up, because you're not going to be able to get it from other countries. And then that idea of the BRIC countries taking on the yuan versus the US dollar, all that sort of currency debate, they're not going to replace the US dollar because they have a closed economy. China doesn't, you can't use your MasterCard, your American Express in China. It's very, very tight currency controls, so they can never become currency of the world. But for trading, they can influence. And that is a great concern for strategic. So this conference here tomorrow is a lot about strategic minerals.
Right.
And so I think that we have to take a look at that. A gold producer in North America is going to become more valuable. If you have any strategic minerals here, they're going to become more valuable as China continues with its predatory practices, as we've seen what Russia did going to Ukraine. And this is set up a different sort of structure globally that I don't like to talk on the fear trade. But I think that those global politics make it so, because the BRIC countries led by China is just trying to attack the U.S. currency. And that sets up another dynamic for gold to trade higher.
And they're buying and holding gold to be able to support their own economies. They're not. So are you seeing a bifurcation in the gold market itself? We've heard about things like that with uranium. We've heard about, obviously, natural gas. As we get this split between the Russia-China bloc and their allies, or the economies that are very, very tied into them, are we potentially in a position where the gold prices themselves, not just the values of the gold companies, but the price of gold itself, becomes very different depending where you are?
Absolutely. And we used to find this a long time ago in exploration companies. Canada is 80% of the explorers. But you would see an ounce of reserves in the ground in Kazakhstan worth $3, and that same ounce in Quebec worth $100. How could that, the same ounce of gold, how could that difference? Because you'll never get it out of Kazakhstan. They'll find some way to steal it from you as you put all this capital to build a mine. So you will see that, and I think that's going to be an important next level that's going to take place. So from that end, I say to people that look at the rise of India, and India is so important. If you look at the S&P 500 tech stocks, how many are Indians? Not many Chinese, only NVIDIA is from Taiwan. So you have this interest that the relationship with India and America and in the tech space, and you have this other dynamic that India's population this quarter just surpassed China, and they're having more children, and there's a cultural affinity for gold. So as long as that GDP is rising in India, I believe that you're going to see that demand for every time there's a sell-off come out of India. They can put on taxes, it doesn't matter. There's always a way that people have this cultural affinity. And Indian women to this day wear 6 times the amount of gold that's in Fort Knox.
And they're the number one importers of silver.
Yes.
And for similar reasons. A lot of it is the jewelry industry. A lot of it goes to export.
Yeah.
But they're looking at new rules to support silver importers, that they want to mirror the same policies they have for gold, where you get direct loans based on gold. You can even pay back your loans in gold. They want to apply that to silver. So precious metals will be getting only more interesting in India, I'd say.
Yeah, absolutely. So it's a very exciting space to be in. And you have to have the courage to see the long term, that the supply side is going to be limited, and the demand of the world, now 8 billion people, they're going to continue to have babies, and they have to feed people. So it remains that this demand is actually, so it will just continue to grow. And I believe that this idea of MMT is not finished yet as a concept. And I think that just means more money printing that always makes tangible assets like art, like limited art supply. We talked earlier about art. It's incredible to see Master Arts now, all this marketing they're doing, because they're showing how much money you're making in limited supply, right. Limit gold. Gold from Canada is better, like they did with diamonds, safe diamonds. I do think the world's going to this sort of bifurcation.
Okay. Now, you mentioned MMT, that's right. So modern monetary theory. Let's circle back to that a little bit, because you say there are some major risks on that front. So we've seen U.S. economic data come out looking very positive, but you're saying that CPI, that inflation is not necessarily better at all, that core CPI is exactly where it was in May of 2022. But the Fed is still acting, because a lot of this is managing expectations and making people feel good about the economy and hoping that wishes become reality. So the Fed is still acting as if it is, and is guiding their monetary policy according to a theory that the economy is in fact improving and these indicators are significantly better. So you said this could cause another crisis. Can you elaborate on that a little bit?
Well, it'll just, the idea of printing money faster than you can think of. And what happens is that in the MMT, after each crisis, the amount of money to repair, it grows exponentially. It's not growing on a linear basis. Populations are not growing exponentially, but the printing of money is growing exponentially. So that there'll be a wake-up point where all of a sudden people are going to say, I've got to own tangible assets as much as I get my hands on. What we did see after COVID in America, go to a Nike store and they won't give you a penny, a nickel, a dime, a quarter. It's dollar bills or it's credit card, because there's a shortage, they tell you, of coins. What's the silver premium at Kitco? What's silver at this price, but they want to buy a silver coin is a huge premium. I am of the belief that the premium is not going to come down. The price is going to go to the premium.
So the premium is going to lead the actual base price of these metals.
That's what I believe, because of MMT and the knowledge of it in media sources such as yourself. The CNNs or CNBCs, they're not going to really talk about that. But decentralized media outlets like Kitco, like Reddit, Twitter, is where a lot of young people go to get their information. And the same thing on YouTube. They go to get their information, they watch your interviews, they share those interviews. And so they're not, if they're watching you and I chat right now, they're not watching mainstream centralized media. They're not watching CBC. They're watching us. And that it will continue to grow. And we're going to talk about this subject. They're going to learn from here, and they're going to share with other people. And I believe that's the positive contagion of decentralized media, just like gold is decentralized.
Very interesting. So we could get something like GME, but in the precious metals space, where you get an enormous number of people talking about it, holding it, and believing in it, and ultimately changing the market itself.
change the market dynamics. Absolutely.
Very interesting. Well, let's come back to some of the mining. So you're saying that the miners themselves could be the best investment going forward, because I'll get you on gold prices before we finish. But I wanted to look at the miners. So which companies do you think are poised to have the strongest finish to 2023 and beyond? If we take seriously this idea that the undervalued miners are going to have the largest upside in this as gold goes forward.
I think it's what I've seen is that the business model of the royalty companies is a superior business model. And I was blessed to know Pierre Lassonde at the very beginning. It's the first deal I ever took public, was Franco-Nevada, and how that pivoted to the royalty model based on Seaboard Shorelink's knowledge of oil royalties. And to see how the revenue per employee of Franco-Nevada is $34 million per employee. $34 million. Goldman Sachs is not $1 million. We're talking about something very significant. And then you see quant funds in the U.S. owning Franco-Nevada. You're seeing that generalized funds of Fidelity use Franco-Nevada as their proxy because it has these high margins and has a dividend. So they have basically only 24 employees. I think I love the royalty companies because they can all of a sudden quickly throw off free cash flow. Free cash flow attracts a huge audience of quants. Investors Business Daily newspaper is all about revenue last quarter or 4 quarters and cash flow on a per share basis. And once the gold stock starts showing there, they start new valuations start taking place. So free cash flow is very important for you to all of a sudden get into a bigger basket of names. And gold goes to $2,500. Well, these royalty companies will just crush it. Now, the other mining companies, the ones that have great discipline of the free cash flow, they'll outperform because they'll start to show up with the rising gold prices much more quickly than the market will. Unless you have a hot product like NVIDIA has. If you don't have that, then you're going to have to be really conscientious of your revenue per share growth. So let's take a look. Gold goes up, say, 5%. So immediately I look at what gold stocks revenue went up 5%. If they went up only 3%, that means they issued shares faster than the price of gold. Now, if they went up a minimum of 5%, but if they went up 8% and price of gold went up 5%, that means there's more economic value for that movement in gold per share. Then quant funds all over the world just come in, they start buying that. They're agnostic. All they're looking for is revenue and cash flow per share, growth metrics, and they come in.
So who are these winning companies? Who are the companies whose share prices are outperforming the gains in gold?
Well, you can take a look at Franco-Nevada. It's one of just a classic. And Wheaton Precious is another of those royalty companies. Osisko would be in there. It's also improved those metrics of when you look at the universe of all gold stocks and you look at the universe of the S&P 500, they're very attractive. And once you start getting that, there's a shortage of gold from North America, and you start getting the supply end of restriction, they're going to become even more valuable.
So you're essentially you're investing in, I guess it's the best of 3 worlds in a sense, because the royalty companies, you're investing in equities, you're investing in a company, you're investing in the underlying asset, you're investing in gold, so you're kind of invested in the commodity, but then you're also investing in this huge upside because they're going to get paid in the commodity as it becomes more valuable. So you're kind of multiplying your upside.
And the last part is,
but are they also leading the potential gains for the gold companies? Because I also want your sense of which of the gold companies, the major gold companies, are in a position to benefit the most from what you're describing.
What you want to look at each quarter, and what we do when we look at our quant approach, we have a basket in GoAU, which is listed in New York Stock Exchange, and it's dominated by the royalty companies. Always the 3 big numbers are 10% each. The rest are all based on who has the strongest revenue, who has the strongest cash.
Who's outperforming that 5%?
And if you start doing things that you don't control, a mine problem, whatever, it strikes, then you're gone. It's only to stay long the leaders, and the leaders have to show that growth and that revenue per share on a relative basis and that cash flow on a per share basis. And we have gone back 8,000 hours of research of looking at every up and down cycle. And now I would say it's gone back about 15 years of data. And that discipline, you outperform buying just an index of gold names. And that's just sort of the thought process. What's really important also is corporate governance. The boards of directors are very sensitive and conscientious now of rewarding CEOs that show the growth per share. And if they make an acquisition and it's not accretive, they don't want to do it because it has to be accretive for those options to have any real value. So I really think that that's extremely positive for this industry, and that's why 60% of the universe have free cash flow right now.
All right, so they're being watched like a hawk by their own boards of governors to not get into some of the types of M&A activity they were years ago. And when they get into something, it has to be good for the existing investors. Has to be good for everybody who's already holding the stock. Right, you can't just massively dilute.
And Newmont's got great management, but we don't own Newmont. Why? Because that acquisition is very dilutive on a per share basis. Yes, they're now the biggest, but when you look on a per share basis, other names are much more attractive.
All right. Now, before I let you go, I wanted to know what else you're paying attention to in the mining and metals space. So we've talked a lot about gold. We've talked about a few different angles for gold and what the U.S. government in particular, what the impact is in Europe and also in the U.S. on gold. What are some of looking at potentially battery metals, copper, lithium, what are some of the other areas that you're really paying attention to, and what are driving those areas for you?
Well, I think I said before, when you look at government policies, there's always an imbalance. The bigger the imbalance, the more important gold becomes. Once you leave gold, you have to start looking at the industrial element of silver. And so silver is very fortunate because of all this money going in for climate change concerns and those policies of the governments for that. It makes it, silver has a huge wind at its sail. And that makes it very bullish in addition for jewelry demand and for electronics demand, it's solar panel demand. So I think that silver is that unique, that PMIs in China turn and Germany when they turn, silver will torque bigger. And with gold goes up, and silver's always been that warrant on gold. So if gold goes up 10%, silver would go up 15%. Gold goes up 10%, silver can go up 25%.
But always lagging.
Yes, but when it moves, and all of a sudden it takes off. It's the leader, and then all this money starts piling into silver deals looking for silver. And we've seen this cycle over the past 20 years several times where silver stocks actually do exceptionally well, but there's greater on the downside. They fall more. That's just recognizing that.
So when do you see, based on your analysis of the gold market right now, when do you see this move happening for silver?
So I think
by quarter, not necessarily the exact.
I think we deal with. You have to always think on the U.S. You're dealing with the presidential election cycle. 18 months from now, we're going to have another election, and so that will sort of have an important factor of what those policies are going to be, and then they're going to have the monetary policies, what they're going to be. And for your listeners, it's really simple: fiscal policies, tax regulations, and spend. That's it. That's the two levers. Are they good policies? Yes or no? Over here, monetary is money supply and real interest rates. But they've stalled real interest rates still negative. And they changed the CPI number calculation a while ago, like 18 months ago. So CPI, if you go back to the 1980 level, it's running at 11%. So as more people become aware of that, then buy the dip, you buy your gold, and you buy your silver, and you buy those good gold names. But I think it's not wise to just to buy the gold and silver. You want to buy the quality gold stocks, because in that rise with gold, the stocks will always go up more. It's always 2-to-1, sometimes 3-to-1 leverage on the upside.
All right. Well, that's very encouraging. Thank you so much for joining us today.
It's great to be with you.
I'm Ernest Hoffman for Kitco Mining. Keep it here for more coverage from Quebec City, and don't forget to subscribe.
Kitco Mining special coverage of the Mining Investment Event of the North is brought to you by EMX Royalty Corp.